Ind AS 37, provision, contingent liability and contingent assets. The meaning of provisions. Provisions are liability of uncertain timing or amount. Liability. What is a liability? Liability is a present obligation arising from a past event, and it is for which the settlement of which is expected to result in an outflow of resource from the entity. Now, present obligation arising from past event for which the settlement of which is expected to result in an outflow of resource from the entity. Now, after liability, the provision is a liability of uncertain timing or amount. Uncertain timing or amount means it requires a measurement by a substantial degree of estimation. So, it requires measurement by substantial degree of estimation. Provisions are liability of uncertain timing or amount. Provisions are a liability of uncertain timing or amount. So, coming again, provisions are liabilities of uncertain timing or amount. Liabilities are actually present obligations arising from past events, the settlement of which is expected to result in an outflow of resource from the entity. Provisions are liability of uncertain timing or amount. So uncertain timing or amount means which requires measurement by substantial degree of estimation. Now, when a past event is deemed to give rise to a present obligation, if it is probable, probable means it's more likely than not. If chances of occurrence are more than chances of non-occurrence, it is probable. So when it is more likely than not. Next, the past events which give rise to obligation on balance sheet date are obligating events. The obligations arising from past events. There are two types of obligations that can come from past events. There are legal obligations, there are constructive obligations. Legal obligations come due to contracts, legislation, any other obligation of law. Constructive obligation means it derives from the entity's own action. It may be due to past practice, published policies, specific statements, or which indicates that the entity will accept the responsibility and create a valid expectation on the part of the other parties. Recognition of provision. If all the conditions are satisfied, now the conditions are there must be a present obligation which arises from the past event. There should be an outflow of resource which is required to settle the obligation that is probable. A reliable estimation can be made for the amount or timing of obligation. These three conditions are to be satisfied to be recognized as a provision. Only those obligations which exist independently from the entity's future conduct of business should be recognized. Only those obligations which exist independently from entity's future conduct of business should be recognized. In other words, obligations which are dependent on future conduct of business should not be recognized as provision because outflow of resources is not probable. All obligations involve another party. It is not essential to know the identity of the other party for recognition of the provision. It will involve another party, not essential to know the identity. Legal obligation arises only when legislations are enacted or it is virtually certain by the end of the reporting period that it will be shortly enacted. Contingent liability. Now provisions is over. Contingent liability. Meaning of contingent liability. Again, liability, right? So present obligation from past events, but which cannot be recognized because either outflow of resource to settle the obligation is not probable, reliable estimation cannot be made, or possible obligation arising from past event, the existence of which will be confirmed only by occurrence or non-occurrence of certain future events, which is not wholly within the control of the enterprise. There are two ways contingent liability can come in. One way is there is a present obligation from a past event. It cannot be recognized because the outflow of resource to settle the obligation is not probable, or reliable estimation cannot be made about what is the how much amount to be paid. And then there is possible obligation arising from past event, the existence of which will be confirmed only by the occurrence or non-occurrence of uncertain future events, which is not wholly within the control of the enterprise. Now, recognition. Not to, it is not recognized, but it requires disclosure in financial statements unless outflow of resources remote, where an entity is jointly and severally liable for an obligation. The part of the obligation that is expected to be met by the parties should be treated as a contingent liability. So it is not actually recognized, but it requires disclosure in the financial statements unless the outflow of resource is remote, which means the probability is very low. Next is contingent asset. Contingent asset meaning meaning of contingent asset. Now, contingent asset means possible asset. Now, there is possible inflow arising from past events, existence of which will be confirmed only by occurrence or non-occurrence of one or more future event, uncertain future event, which is not wholly within the control of the enterprise. Now, this is the contingent asset, recognition and disclosure. Inflows, there are three ways. Virtually certain means greater than 95%, probable means more than 50%, and not probable means less than 50%. When it is virtually certain, it shall be recognized as an asset, but and not treated as contingent asset, because it is virtually certain that this asset is ours. It's a possible asset. It's virtually certain that it is our asset. Probable, meaning greater than 50% chance. No asset is recognized. It is a contingent asset. Disclose it in the financial statements and notes to accounts. If it is not probable, which is less than 50%, there is no treatment. Now, if it is again coming back to, if it is less than greater than 95%, it shall be recognized as an asset and not treated as a contingent asset. If it is greater than 50%, it is not recognized as an asset, but it is a contingent asset. It should be disclosed in the financial statements, notes to accounts. Now, if it is less than 50%, there is no treatment. Next, measurement of provision and contingent liability. Best estimate of expenditure required to settle the obligation at the end of the reporting date. That is the best estimate of the expenditure which is required to settle the obligation at the end of the reporting date. Estimations are determined by management's judgment. It needs to be supported by experience of past transactions or report of an expert or any additional evidence provided by event occurring after the reporting date as per Ind AS 10. Any additional evidence provided by event occurring after the reporting date. Now, how to measure? When obligation involves a large population, we determine expected value of obligation, that is weighted average of all possible outcomes. Weighted average of all possible outcomes. When obligation involves a large population, determine expected value of obligation. When there is a single obligation with two possible outcomes, provision is created based on most likely outcome. Present value. Where the effect of the time value of money is material, the amount of provision should be the present value of the expenditure expected to be required to settle the obligation. The expected present value of outflows are calculated as follows. Each outcome is discounted to its present value. The present value of outcomes are weighted by their associated probabilities. The discount rate should be pre-tax rate and provision should be measured before tax. Again, coming back to the present value, each outcome is discounted to its present value. The present value of outcomes are weighted by their associated probabilities. Expected disposal of assets. Next, gains on the expected disposal of assets should not be taken into account in measuring a provision. An entity should recognize gains on expected disposal of assets at the time specified by the respective Ind AS. Next, risks and uncertainties. The risks and uncertainties that surround many events and circumstances shall be taken into account in reaching the best estimate of a provision. Risks and uncertainties that surround many events and circumstances shall be taken into account in reaching the best estimate of a provision. A risk adjustment should be made for the amount that the entity would pay in excess of the expected present value of outflows due to uncertainty attached with the actual outcome. A risk adjustment should be made for the amount that the entity would pay in excess of the expected present value of outflows due to uncertainty attached with the actual outcome. Risk adjustment can be accounted for in the number of for in a number of ways, such as adding to the expected present value of future outflows, adjusting the estimates of future outflows, adjusting the discounting rate. Next is reimbursement. When expenditure required to be settled is expected to be reimbursed by a third party. Reimbursement can be expected, it can be virtually certain, which is greater than 95%. If reimbursement is virtually certain, then uh, you recognize reimbursement as a separate asset. Such amount is set off against the provision and net amount is shown profit and loss. Amount recognized as reimbursement asset should not exceed the amount of provision. If it is not virtually certain, not recognized as an asset, however, if inflow is probable, expected reimbursement should be disclosed in notes to account. Future operating loss. Neither provision nor contingent liability, as it is related to a future event. It's a future operating loss. It relates to the event that occurs in the future itself. The next financial year, if you're getting an operating loss, that is not a contingent liability to be recorded now, because that is related to the future event. Executory contract. Executory contracts are contracts under which neither party has performed any of its obligations, or both parties have partially performed their obligations to an equal extent. This standard does not apply to executory contracts unless they are onerous. Now, what is onerous contract? Onerous contract is a contract in which the unavoidable costs of meeting the obligations under the contract exceeds the economic benefits expected to be received under it, which means it is going to be loss making. If an entity has a contract that is onerous, the present obligation under the contract shall be recognized and measured as a provision. The cost of fulfilling a contract comprises the costs that relate directly to the contract. Costs that relate directly to the contract consist of both incremental costs of fulfilling that contract, for example, direct labor costs and materials, and allocation of directly attributable costs, for example, depreciation for an item, PPE used in fulfilling the contract, among others. The unavoidable costs of meeting the obligations under the contract are only costs that are incremental to the performance of contract and do not include allocated costs that will be incurred regardless of whether the entity fulfills the contract or not. It cannot be avoided by the entity's future actions. In this case, amount of provision equals unavoidable cost, which is lower of cost of fulfilling the obligation, any compensation of or penalties arising from failure to fulfill it. Before a separate provision for an onerous contract is established, an entity should recognize any impairment loss that has occurred on assets used in fulfilling that contract in accordance with Ind AS 36. Next is changes in provision. Provision must be reviewed at each reporting date and adjusted to reflect best current estimate. If provision is no longer required as it is not probable, amount of provision must be reversed. Provision must be reviewed at each reporting date and adjusted to reflect best current estimate. If provision is no longer required as it is not probable, amount of provision must be reversed. Next is unwinding of provisional amount. When discounting is used, carrying amount of provision increases every year. That increased amount is treated as borrowing cost that should be charged to P&L. Next is use of provision. A provision should be used only for the expenditure for which it was originally recognized. In other words, it cannot be used for any other purpose. Provision for rent shall be put for provision for against rent expense itself. Accounting treatment. For recognition of provisions, if it is related to an expense, expense debited to provisions. If it is related to acquisition or construction of assets, it will be asset account debited to provisions. For reversal of provisions, for if it is related to expense, it will be provisions debited to expense, reverse of expense to provisions. Similarly, likewise, if it is related to acquisition of assets, provision debited to asset. Asset to provisions is recognition of provision, provision to asset is reversal of provision in case of acquisition and construction of assets. If it is related to expense, expense to provision is recognition of provision, provision to expense is reversal of provision. Restructuring. It is a program which materially changes the scope of business. For example, sale of division or a component, termination of a division, closing of business location or relocating. A provision for restructuring costs is required when recognition criteria of provisions are satisfied. A constructive obligation for restructuring arises when entity has detailed formal plan of restructuring and entity has started to implement such plan or announce the main features of restructuring plan to those affected by it. Measurement of provisions. A restructuring provision should include only the direct expenditures arising from the restructuring, which are those that are both necessarily entailed by the restructuring and not associated with the ongoing activities of the enterprise. The restructuring provision does not include such costs as retraining or relocating continuing staff, marketing, or investment in new systems and distribution networks. These expenditures relate to the future conduct of business. Future operating losses up to the date of restructuring. Future operating losses up to the date of restructuring are not included in a provision unless they relate to an onerous contract. Reading again. Measurement of provisions. A restructuring provision should include only the direct expenditures arising from the restructuring, which are those that are both necessarily entailed by restructuring and not associated with ongoing activities of the enterprise. It should be necessarily entailed by restructuring. It should be not associated with the ongoing activities of the enterprise. Next, a restructuring provision does not include such costs as retraining or relocating continuing staff, marketing, investment in new systems and distribution, because these expenditures relate to future conduct of the business. Future operating losses up to the date of restructuring are not included in provision unless they relate to an onerous contract. Ind AS 37 is not applicable for executory contracts unless it is onerous. Now I'm reading the scope of Ind AS 37. Ind AS 37 is not applicable for executory contracts unless it is onerous. It is not applicable for financial instruments, because Ind AS 32 and 109 takes care of that. It is not applicable for income tax because Ind AS 12 takes care of that. Does not apply to employee benefits because Ind AS 19 takes care of that. Insurance contracts, Ind AS 104 takes care of that. It is not applicable to contingent consideration arising in business combination because Ind AS 103 takes care of that. Now, for disclosures, for each class of provision, a brief description of the nature of obligation, an indication of the uncertainties about the amount, timing of those outflows, the amount of any expected reimbursement, stating the amount of any asset that has been recognized for the expected reimbursement. Again, disclosures. For each class of provision, a brief description of nature of obligation, an indication of uncertainties about the amount or timing of those outflows, the amount of any expected reimbursement, stating the amount of any asset that has been recognized for that expected reimbursement. For each class of contingent liability, a brief description of the nature of the contingent liability, where practicable, in an estimate of its financial effect, an indication of uncertainties relating to the amount or timing of any outflow, the possibility of any reimbursement. For each class of contingent assets, a brief description of the nature of the contingent asset and an estimate of their financial effect where practicable. Where any of the above information is required is not where any of the above information required is not disclosed because it is not practicable to do so, that fact shall be stated. This is the brief of Ind AS 37. Ind AS 37, provision, contingent liability and contingent assets. Solving questions in Ind AS 37, provisions, contingent liabilities and contingent assets. Question number 1. ABC Limited is an automobile component manufacturer. The automobile manufacturer has specified a delivery schedule, non-adherence to which will entail a penalty. As on 31st March 2001, the manufacturer has a delivery schedule for June 2002. However, the manufacturer is aware that he will not be able to meet the delivery schedule in June 2002. Determine whether the entity has a present obligation as at 31st March 2001, requiring the recognition of provision. Now, in this case, there is no present obligation arising out of a past event, as the goods are scheduled for delivery in June 2002 and there is no delay as at 31st March 2001. Hence, there is no present obligation to pay the penalty in the current year. Therefore, there is no present obligation to recognize the provision. Next, X Shipping Limited is required by law to overhaul its shipping fleet once in every 3 years. The company's finance team was of the view that recognizing the costs only when paid would prevent the matching of revenue earned all the time with certain costs of large amounts which are incurred occasionally. Therefore, thereby, it has formulated an accounting policy of providing in its books of accounts for the future cost of maintenance, which are overhauls, annual inspection, etc., by calculating a per hours rate per hour sailed in the sea and accumulating a provision over time. The provision is adjusted when the expenditure is actually incurred. Is the accounting policy of X Shipping Limited correct? A provision is made for a present obligation arising out of a past event. Overhauling does not arise out of a past event. Even a legal requirement to overhaul does not make the cost of overhaul a liability because no obligation exists to overhaul the ships independently of the company's future actions. The company could avoid the future expenditure by its future actions, for example, by selling the ships. So there is no present obligation. As per the standard, financial statements deal with the financial position of an entity at the end of its reporting period and not its possible position in the future. Therefore, no provision is recognized for the cost that needs to be incurred to operate in the future. The only liabilities recognized in an entity's balance sheet are those that exist at the end of the reporting period. Therefore, the accounting policy of X Shipping Limited is not correct. The company should adopt the component approach in Ind AS 16, property, plant and equipment, for accounting for the refurbishment cost. X Chemical Limited is operating in the vicinity of a river since 20 years. A community living near X Chemical Limited claims that its operations has caused contamination of drinking water. X Chemical Limited has received a notice from the Governmental Environmental Agency that official investigations will be made into claims of pollution caused by the entity. If it is found that X Chemical Limited has caused contamination, then penalties would be levied on it. X Chemical Limited believes that it has implemented all environmental safety measures to an extent that it is unlikely to cause pollution. Management is not sure whether it has all the information about entire 20 years. Therefore, neither management nor external experts are able to assess X Chemical Limited's responsibility until the investigation has completed. In such situation, how should management of X Chemical Limited account for a liability? As per the standard, in the present case, the available evidence does not support a conclusion that a present obligation exists. However, there is a possible obligation which exists and will be confirmed upon completion of investigations. Therefore, the management should disclose the contingent liability for potential penalties and fines that may be imposed if contamination is proved. X Limited is another question. X Limited has entered into an agreement with its selling agent Y, in accordance with which X Limited has to pay a base percentage of commission on export sales, and an additional commission is to be paid if the export incentives are received. As per the accounting policy of X Limited, it recognizes export incentives when actually realized. On account of the uncertainty in realizing such incentives, export incentives have on account of it recognizes export incentives when actually realized on account of the uncertainty in realizing such incentives. Export incentives have not been received for the year 2001-2002. However, X Limited is hopeful of receiving the export incentives in the year 2002-2003. In the financial statements for 2001-2002, should X Limited provide for both base commission and additional commission? So far as the base percentage of sales commission is concerned, it is present it is a present obligation arising out of past events. The obligating event takes place when the sales are made, and also since commission is based on percentage of sale, reliable estimation can also be made. Therefore, the base percentage of sales commission should be provided. However, in respect of additional commission, it is to be paid when the export incentives are recognized, and export incentives are recognized only when it is received. Therefore, the obligating event will arise only when export incentives are received. Hence, no provision for additional commission is to be made in the financial year 2001-2. The expectation of X Limited to receive the export incentives in the next year would not make any difference as on 31st March 2002. An entity sells goods with a warranty under which customers are covered for costs of repairs. Any manufacturer, come again. An entity sells goods with a warranty under which customers are covered for the cost of repairs of any manufacturing defects that become apparent within the first 6 months after purchase. If minor defects were detected in all products sold, repair costs of 1 million would result. If major defects were detected in all products sold, repair costs of 4 million would result. The entity's past experience and future expectations indicate that for the coming year, 75% of the goods sold will have no defects. 20% of the goods sold will have minor defects, and 5% of the goods sold will have major defects. Assess the probability of an outflow for warranty obligations as a whole. So, minor defects for all products will be 1 million. Major defects for all products will be 4 million. So, they are telling 20% of the goods will have minor defects, 5% of the goods will have major defects. So the expected value of cost of repairs will be 75% multiplied by 0, 25% multiplied 20% multiplied by 1 million, 5% multiplied by 4 million, which gives us 4 lakh. 20% of 1 million, 5% of 4 million together. X Solar Power Limited, a power company, has presented obligation to has a present obligation to dismantle its plant after 35 years of useful life. X Solar Power Limited cannot cancel this obligation or transfer to a third party. The company has estimated the total cost of dismantling at 50 lakh, the present value of which is 30 lakh. Based on the facts and circumstances, the, the company considers the risk factor of 5%, that is, the actual outflows would be more from the expected present value. How should solar how should X Solar Power Limited account for the obligation? The obligation should be measured at the present value of outflows, that is 30 lakh. Further, a risk adjustment of 5%, because considers the risk factor of 5%, that actual outflows would be more than the expected present value. So 5% of risk adjustment shall be made. 5% of 30 lakh will be 1 lakh 50. So the liability will be recognized at 30 lakh plus 1 lakh 50, which is 31 lakh 50. ABC Limited has an obligation to restore the seabed before the damage it has caused in the past. It has to pay 10 lakh in cash on 31st March 2003 relating to this liability. ABC Limited's management considers that 5% is an appropriate discount rate. The time value of money is considered to be material. Calculate the amount to be provided for at 31st March 2001 for the cost of restoring the seabed. Discounting factor of 5% for second year as on 31st March 2001 will be 1 divided by 1.05, the whole square will be 0.907. The present value of the provision as on 31st March 2001 is 10 lakh multiplied by 0.907, which is 9 lakh 7,000. The amount of increase in the provision resulting from unwinding of discounting to reflect the passage of time should be included as an element of borrowing cost in the determining of profit or loss for the year. The provision should be initially recognized at 9 lakh 7,000, which is the present value of 10 lakh discounted at 5% for 2 years. At the end of year 1, 31st March 2002, the provision increases to 9 lakh 52,350, and the difference of 45,350 is recognized as borrowing cost. Similarly, at the year ending 31st March 2003, the provision will be increased to 10 lakh, and the increase being recognized as borrowing cost. Consequently, at the end of year 2, the amount of provision will be equal to the amount due, which is 10 lakh. X Chemicals engaged in chemical industry X Chemicals Limited, engaged in the chemical industry, causes environmental damage by dumping waste in the river near its factory. It does not clean up because there is no environmental legislation requiring cleaning up, and Chemicals Limited is causing damage for the last 40 years. As of March 31st, 2002, state legislature has passed a path-breaking legislation requiring all polluting factories to clean up the river water already contaminated. The formal Gazette notification of the law is pending. How would X Chemicals Limited deal with this situation? The obligating event is the contamination of water, and because of the virtual certainty of legislation requiring the cleanup, an outflow of resources certain. It is possible to arrive at best estimated cost for cleanup activity, so a provision should be recognized in the books of X Chemicals Limited for the year 2001-2002. X Beauty Solutions Limited is selling cosmetic products under the brand name B, but it is getting its product manufactured from Y Limited. It has an understanding with Y Limited that if the company becomes liable for any damage claims due to any injury or harm to the customer of the cosmetic products, 30% will be reimbursed to it by Y Limited. During the financial year 2001-2002, a claim of 30 lakh demanded by the customers from Beauty Solutions Limited, X Beauty Solutions Limited. How should X Beauty Solutions Limited account for the claim that becomes payable? Since the understanding results in an enforceable agreement, the reimbursement of 9 lakh, which is 30% of 30 lakh, shall be recognized as a reimbursement right, and provision will be recognized for 30 lakh. The reimbursement right shall be treated as a separate asset and shall not be offset with the provision. In the statement of profit and loss, the expense may be presented as 21 lakh after offsetting the reimbursement right. X Telecom Limited has an income tax litigation pending before appellate authorities. Legal advisor's opinion is that X Telecom Limited will lose the case and estimated that liability of 1 crore may arise in 2 years. The liability is recognized on a discounted basis. The discount rate at which the liability has been discounted is 10%, and it is assumed that discount rate does not change over the period of 2 years. How should X Telecom Limited calculate the amount of borrowing cost? The discounting factor of 10% for 2 years is 0.827. X Telecom Limited will initially recognize the provision at 1 crore multiplied by 0.826, which will be 82 lakh 60,000. The discounting factor of 10% at the end of the year 1 is 0.909. At the end of year 9, the provision amount would be 90 lakh 90,000, which is 1 crore multiplied by 0.909. So as per the standard, the difference between the two present values, 8,30,000, will be recognized as borrowing cost in year 1. At the end of year 2, the liability should be 1 crore. The difference between the two present values, which is 1 crore and 90 lakh 90,000, is 9 lakh 10,000, which will be recognized as borrowing cost in the year 2. X Packaging Limited has two segments, Packaging Division and Paper Division. In March 2001, the board of directors approved and announced a formal plan to sell the paper division in June 2001. Operating losses of the paper division are estimated to be approximately 50 lakh during the period from April 1, 2001 to the expected date of disposal. Management of X Packaging Limited wants to include the future operating loss of 50 lakh in a provision for restructuring in financial statements for the period ended March 31st, 2001. Can X Packaging Limited include these operating losses in a provision for restructuring? Standard states that provision should not be made for future operating losses. Since Ind AS 37. Standard states that provision should not be made for future operating losses. Since Ind AS 37 prohibits the recognition of future operating losses, so Packaging Limited should not include these future operating losses in the provision for restructuring, even though these losses relate to the disposal to the disposal group. X Metals Limited had entered into a non-cancellable contract with Y Limited to purchase 10,000 units of raw material at 50 per unit at a contract price of 5 lakh. As per the terms of the contract, X Metals Limited would have to pay 60,000 to exit the said contract. X Metals Limited has discontinued manufacturing the product that would use the said raw material for use the said raw material. For that, X Metals Limited had identified a third party to whom it can sell the said raw material at 45 per unit. How should X Metals Limited account for this transaction in its books of accounts in respect of the above contract? These circumstances do indicate an onerous contract. The only benefit to be derived from the purchase contract costing 5 lakh are the proceeds from the sale contract, which are 4 lakh 50,000. Therefore, a provision should be made for the onerous element of 50,000, being lower of cost of fulfilling the contract and penal cost of cancellation of 60,000. X Cements Limited has 3 manufacturing units situated in three different states of India. The board of directors of X Cements Limited, in the meeting held on January 10, 2001, decided to close down its operations in one particular state on account of environmental reasons. A detailed formal plan for shutting down the above unit was also formalized and agreed by the board of directors in that meeting, which specifies the approximate number of employees who will be compensated and expenditure expected to be incurred. Date of implementation of plan has also been mentioned. Meetings were also held with the customers, suppliers, and workers to communicate the features of the formal plan to close down the operations. In the said state, operations in the said state, and representatives of all interested parties were present in those meetings. Do the actions of the board of directors create a constructive obligation that needs a provision for restructuring? As per Ind AS 37, the conditions prescribed are: there should be a detailed formal plan of restructuring, which should have raised valid expectations in the minds of those affected that the entity would carry out the restructuring by announcing the main features of its plan to restructure. The board of directors did discuss and formalize a formal plan of winding up the operation in the above said state. This plan was communicated to the parties affected and created a valid expectation in the minds of X Cements Limited. X Cements Limited would go ahead with its plans to close down operations in that state. Thus, there is a constructive obligation that needs to be provided at the year end. A manufacturer gives warranties at the time of sale to purchase its three product lines. Under the terms of warranty, the manufacturer undertakes to repair or replace items that fail to perform satisfactorily for 2 years from the date of sale. At the end of the reporting period, a provision of 60,000 has been recognized for sale made during the year. The provision has not been discounted as the effect of discounting is not material. Draft the note. So the note will be: a provision of 60,000 has been recognized for expected warranty claims on products sold during the current financial year. It is assumed that majority of this expenditure will be incurred in the next financial year, and all will be incurred within 2 years from the reporting period. X Limited is reporting in the telecom industry. Sorry, X Limited is operating in the telecom industry. During the financial year 2001-2002, the income tax authorities sent a scrutiny assessment notice under Section 143, subsection 2 of the Income Tax Act 1961 in respect to return filed under Section 139 of this Act for previous year 2000-2001, assessment year 2001-2002, and initiated assessment proceedings on account of a deduction claimed by the company, which in the view of the authorities was inadmissible. During the financial year 2001-2002 itself, the assessment proceedings were completed and the assessing officer did not allow the deduction and raised a demand of 1 crore against the company. The company contested such levy and filed an appeal with the appellate authority. At the end of the financial year 2001-2002, the appeal had not been heard. The company is not confident whether that the company would win the appeal. However, the company was advised by its legal counsel that on a similar matter, two appellate authorities of different jurisdictions had given conflicting judgments, one in favor of the assessee and one against the assessee. The legal counsel further stated that it had more than 50% chance of winning the appeal. Please advise how the company should account for these transactions in the financial year 2001-2002. Ind AS 37 provides that in rare cases, it is cases it is not clear whether there is a present obligation. For example, in a lawsuit, it may be disputed either whether certain events have occurred or whether those events result in a present obligation. In such case, an entity should determine whether a present obligation exists at the end of the reporting period by taking into account all available evidence. For example, the opinion of the experts. In the present case, the company is not confident whether it would win the appeal. By taking into account the opinion of the legal counsel, it is not sure that whether the company would win the appeal. On the basis of such evidence, it is more likely than not that a present obligation exists at the end of the reporting period. Therefore, the entity should recognize a provision. The company should provide for a liability of 1 crore.